Hey guys, thanks for checking out the recordings of the Bridging the Gap workshop. Remember, if you want to join us live and be in the running for some of the cool prizes that we're giving out each day, you can join us by registering at www.tier1trading.com. If for some reason you're seeing this after the fact, register anyway. That way you're in the loop about our next live workshop. Welcome back to day 3 of the Bridging the Gap workshop. If you've been following the theme so far, our goal is to help you bridge some of the gaps in your trading, the things that are stopping you from becoming consistently profitable. And on day 1, we focused on the knowledge gap, talking about information plus discovery equals knowledge, and how discovery is achieved through a process, through practice, through observation, and of course, through experience, and how information by itself, without the discovery part of it, typically ends in destruction. Yesterday, we came back in. We talked about the strategy gap, some really good sessions by Jason Greystone talking about building a strategy. We talked about knowledge equals power, but only potential power, right? Knowledge plus a plan plus a strategy equals your power, your advantage, your edge in the market. And knowledge in its own right, without planning, once again, ends in destruction. Today, we're going to talk about the performance gap. We're going to talk about strategy plus implementation, right? So we're building on each day, on the previous day. Strategy plus implementation equals performance, and how implementation, it requires capability, it requires confidence, and of course, it requires consistency. And once again, strategy without proper implementation ends in, who can fill in the blank here? Information without discovery ends in destruction. Knowledge without planning ends in destruction. Strategy without proper implementation ends in destruction. Yep. And I shared a quote on social media the other day, and it reminded me of this topic. Any golfers out there? Anyone play golf or attempt to play golf or buy a lot of fancy clubs and pretend like they play golf, right? I went through this phase where I thought I was going to be a professional golfer, right? So I was trading, and I was a swing trader. So I'd quit 3 of my jobs to focus on trading. I was trading full time. I was a swing trader. I had nothing better to do throughout the day than just nothing. So I started taking up golf. Charles says, I hit a ball in the woods. Does that count? I'm going to say yes, Charles, because that's typically how my story goes. So I learned how to play golf. My mentor at the time, he encouraged me to play golf. I'm a former athlete, so my body's wrecked from basketball, football, baseball, all these sports growing up. And he wanted me to take up golf because you can be a professional golfer and make lots of money and play golf for a very long time. Financially, it made sense. At the same time, right, I was starting my money management business, and I had read somewhere that Harvard had a business course where they actually took people out to the golf course and taught them to play, because most of the business deals were done on the golf course. So in my head, I'm like, okay, I'm going to get better at playing golf, and I'll get these business deals done on the golf course. I'll grow my money management business and play some sports at the same time. So I started taking up golf, and in college, I would always go to the driving range, and I'd smack the ball around a little bit, right? I'd hit it 300 yards easily. So I'm like, okay, this golf thing is going to be pretty easy. And it wasn't. I started playing golf for real, and kind of like what Charles mentioned, I would spray it everywhere. I'd spray it in I had a streak. I'd hit every water hazard. Every water hazard, I'd be in the woods. I'd be in the roughest of the roughs everywhere. And I like this quote that I said the other day. It said, golf has taught me that success doesn't have to happen at once. I used to drive the ball 300 plus yards each time, thinking the closer I got to the pin, the better I'd be. Eventually, I learned that laying up and taking small bites out of the course was the most efficient approach. And what happened was I was so bad with the driver. We call it the mothership because I hit that thing into space, right? I was so bad with the driver that I lost all confidence in it. I couldn't hit it straight to save my life. I'd hit it backwards sometimes. It was amazing. And I remember I worked with a client who was a golf pro, and he gave me an awesome bit of advice. He said, put it away. He said, just don't use it. I'm like, well, how am I going to get it off the tee if I don't use it? And then he explained to me about, golf is more than just hitting it as far as you can. It's about strategy. It's about planning. It's about knowing the distance to the hole. And he gave me some really good advice. He said, hey, with how you can hit, you can easily accomplish the same thing, if not better, with just your irons. Because if I'm hitting it in the rough and it's going to take me a few extra strokes to get out of it or if I even find it, if I can just hit it 150, 200 with an iron and just keep laying up, I'll get to the pin a lot quicker and a lot more efficient than what I was doing with the driver. And that lesson always stuck with me for a very long time, because I think you see that in trading a lot, where people often try to do too much at once, or people always go for the home run trade, right? The big profits. Have you guys ever found yourself doing that? You want the big move, right? I've spoke to traders before where it's like, yeah, I can't take the trade. It's only got like 50 pips of potential. And I'm like, only? What? But you see that a lot. And what happens is when you go for that big move, when you go for everything at once, baseball is another analogy, you go to hit the home run, you increase the chances and likelihood that you're going to strike out. And what I've learned over the time is that a much better approach to take is the slow, non-impressive, not sexy, boring, methodical approach that ends up getting the job done. But in order to do that, right, you've got to start small. You've got to trust yourself. You've got to plan things out. And of course, you've got to build confidence and consistency in it if you ever want to become really, really, really good. So we're going to start off today's session with the charts, and we're going to add a little bit to yesterday. So yesterday we started off by looking at the charts. We started looking at trading opportunities, kind of breaking down and following up on reading the markets and making predictions. Jason came in later and taught us about the importance of planning and process. Today we're going to revisit the charts, but we're going to add the next level to it. We're going to add kind of the entirety of the trade. So we're going to talk entries, stops, and targets. We're going to talk about measuring out the entire trade and seeing if it's actually a good trading opportunity for us. We're also going to talk about using that if-then thought process to really give you a step-by-step look at how you go about entering trades, or maybe not entering trades. Brad said, I started playing during COVID, thought I was doing pretty good until a mate took me to a legit course. It was I ended up going to a course with 0 trees. That's the only thing that made me good. I could just spray it anywhere and ended up being okay. But one day. So let's start here on the Euro Yen. I'm going to be on the Euro Yen 4-hour chart for all you guys that are following along. And we have a few things happening here. So most recently, the market has been in a bearish move. And even more recently, kind of short term, we've been in a little bit of consolidation, right? You can see that this was our most recent lowest low. I'm actually going to take these VS1s off to make things a little bit more clear for you. This has been our most recent lowest low. You can see that we've been getting higher lows after that. This was the previous outside return. Before that level, you can see that our highs have been getting lower as well. So we can say that the market is in what type of phase? We are in consolidation. Now, with the knowledge, knowing that we're in consolidation, we know that two things are likely, or more likely than they were if we weren't in consolidation. Who can tell me what those two things are? Patterns, yep, advanced pattern formations, right? During consolidations, we see a lot of advanced pattern formations just because that's the nature of how they form, with kind of failed extensions and retracements within retracements. We also know that consolidation, right, contraction leads to expansion, so potential breakouts, right? So we can put two of those things in our head. Now, one can say, wait a minute, those contradict each other, but you'll see that once you have a plan right? There's really going to be, or if you set up your plan correctly, I should say, if you have a correct trading plan, there really should be no contradictions in how you set yourself up. So one thing that's going to help if I want to look for advanced pattern formation is going to be our Enigma tool. And cover your eyes, because this is going to get wild, but I'm going to simplify it for you. So I'm going to click this button. It's going to show you everything that's potentially on the radar. Now, how many of you guys saw that previously? Take it away. Put it back on. Right? Now, it's very important, and you'll ask any of our Tier 1 members that we always say this, right? This is a tool. This is a tool. It's not a say-all, be-all. And everything that Anthony develops for us is to support what we're doing. You can trade it as something outright, where you're going to be like, hey, I'm just going to trade every single pattern it gives me. But then you're going to find yourself in situations like this where it gives you different options. And the idea of this tool is to give you different options based on, or as close as possible to how the human eye would recognize it. But I think we can all agree that not all of us would choose all of these legs. So it gives you options. And what you need to do is you need to go back and ask yourself, which leg would I naturally see? Right? So again, the goal isn't for this to do the work for you. It's to give you support. It's to give you a heads up where some of you guys are like, I didn't see any of this beforehand. Now I do. Now let me focus on my focus and dig in. So we have a few things setting up here. One, if we look down here inside kind of the most recent part of our wedge pattern, right? And I'll bring it on one more time so you guys can see it. We're going to have a potential bat pattern, right? This first leg, this swing high to swing low, this is going to be my X to A. This is going to be my A to B right here. Steve says, how come it doesn't see the smaller bat and the bear Gartley? There are settings that have how small or how large it identifies it. So you may need to go down to a lower time frame to see it. Yeah. So like, trust me, if you had it where it measured every single smaller pattern without minimum or smaller minimums without minimums or maximums, you're going to get a too crowded chart. So you can go in and tweak the settings for the length extremes and the length minimums and stuff like that if you want. But we have our X to A right here, our A to B, our B to C, and our CD completion right up here. So if price action comes to that B level, that 130.39 level, then we're going to have a bearish bat pattern. Now this one's pretty simple. And again, you can tweak how you decide to trade patterns. That's going to be completely up to you. With me personally, I'm very aggressive with how I trade patterns. I just want to enter at the D completion. So I know that my entry goes right here. In this case, it would be a sell limit order. I want to be aggressive. This is the only strategy that I'm aggressive with currently. My sell limit order would be right here, right? My stop loss would be right here. My target placement would be right here. So well before this trade ever occurs, I already know the three things that we always need to know in order to set up our trade: entries, stops, and targets, right? So this is one opportunity right here. Now, let's say you're someone that is expecting a breakout of this range and we push higher. Well, we're going to have something else higher as well. We're going to have swing high to swing low, X to A to B, B to C, and a CD completion up here. And you can use this information in two ways. One, obviously you can trade this as a cipher pattern in its own right. Same thing we talked about the bat, aggressive order at the D. That's how I trade it. Again, you can trade it different ways if you want, all personal preference, right? Or let's say you're someone that is not a pattern trader. Let's say you're someone that is not a pattern trader, but you're trading the breakout of this wedge. You're a trend line trader, and you're waiting for the breakout and the retest. How can the knowledge of knowing that a cipher pattern exists up here, how do you think that can potentially benefit your trading? Any idea? Again, if you're a wedge pattern trader looking for the breakout, so you're looking for a breakout, maybe a breakout and a retest, and you're planning on getting long, how can having the knowledge of this cipher pattern, even if you don't trade it, how can this be helpful for your trading? Yeah, maybe it ends up being a target level. Maybe you don't trade advanced patterns, have no interest in them, but you do understand that, hey, there is going to be some power there and I want to be aware of them. You can use these in your analysis. Again, think like the other traders, what I often say. You can use this in your analysis to give yourself a better idea of, hey, where do I want my potential target to be? And if you know that there's something powerful sitting right here, maybe instead of shooting for this level, you're like, you know what? I'll play it safe and get out right here. By the way, beautiful level of structure looking left right here as well. If you see this little wick up here, we know that just going back to day one, we know that when you see a wick like this, what's the story you can create off of it? What does that mean? What does that big wick, that long leg to the upside mean? Ali says, isn't there a Gartley from Extern from the C point of the cipher? There could be for some. It wouldn't be one for me, but it's not going to be an invalid one, no. So you can certainly make the case for one. Actually, no. I don't think it. Let me just measure it while you guys are answering real quick. I don't know if it is going to be a Gartley. Now I'm interested. Again, it's not one for me, but it could be one. If you hit that 618, yes. You may or may not hit it depending on your data. You may be a little bit off of it, but if you hit it, then yes. If you don't hit it, then no. But just not a setup for me. This is not going to be a leg I would identify. But yeah, a rejection up here. Bulls tried to push up and they failed. Well, if you're buying, guess what you are? Not a bad one, just one that my eyes don't pick up, Rogers. So it's not one for me. If you're buying here, you're a bull. Do you want to shoot into a level where you were previously slapped in the face and rejected before? Or would you rather escape right before that level? I think we'd probably rather escape right before that level. So again, these are very small clues. And this is where knowledge comes in. Really, knowledge shows its power. Because you have one thing, you're trading the wedge, you're trading the breakout. That is your style. You have this other information that maybe you don't necessarily use, or maybe it seems kind of minute, but it comes in handy. Knowing that cipher there gives you a little bit of safety. Being able to read that candlestick and say, I probably want to get out a little bit before that area instead of past that area. That stuff comes in handy. There was a report done. This was a long time ago. I'd love to see a new one. There was a report done, I don't even remember the year. It might have been back in like 2015, where they looked at the data from all retail traders and they looked at the win rate. And let me ask you guys this. Do you think that most traders were above or beyond 50%, or above or below 50%? Right? You assume that most traders are below 50%. Wrong. Most traders actually had a very positive win percentage. Above 50%. Now we know the stats on how many traders lose, so something's kind of off there. And what that tells me is that traders aren't necessarily bad with finding opportunities. Maybe even with making predictions, with entries or areas. It's the stops and targets. And it could be stops and targets from, obviously you just have to assume this data based on kind of, what we've seen over the years. It stops and targets from a technical perspective, being able to pick the right places with a stop and a target. And obviously trading psychology, that's a big one as well. Being able to see your trade out without taking targets early or moving stops back, all of that fun stuff. But it's very interesting that you would assume that most traders are just bad. It's, yeah, as Charles mentioned, bad targets, bad stops, taking targets early, moving stops, is all those other things. All those other things. And that goes into confidence. That goes into consistency. Anthony says risk reward will burn a high win rate system if a person isn't careful. Yep. But right, Anthony, everyone cares about what? What's the most important thing? Everyone cares about the win percentage. Everyone cares about that. I want to have a great win percentage. What you'll learn, and again, we're kind of ingrained to this off of, again, schooling and everything else in life where more always equals better. A higher win percentage in trading isn't necessarily a good thing. Isn't necessarily a bad thing either, but it's not an irrelevant statistic, and we'll talk about this later, and you'll kind of see the power of it. But it's not as important. It's a piece of the puzzle. Right? Let's put it that way, without kind of ruining the later conversation. So, got a question here, Akil. With this many patterns, how do you treat them? I treat them the same. So the thing about this, right, with the two patterns we're looking at, none are going to affect each other, right? So this potential bear bat that's forming, right, is going to have no effect on the cipher, right? Because I'll be stopped out of this trade, assuming I don't move stops back and do weird stuff like that, right? I'll be stopped out of this trade well before this cipher pattern completes. And this was a question we got yesterday too, where I forgot, it might have been Vincent. I forgot who typed it in. It might have been Vincent. We're looking at oil, or he was talking about, well, what about the C leg of this and the pattern of that? And, right now this pattern is irrelevant, right? This is a potential cipher. This is a potential bat, right? It means nothing until it's actually filled. And what you'll see a lot of the times is people will get, well, I'm not gonna take this bat pattern because there's a bigger cipher higher. And that's probably the dumbest thing you can do, right? If this bat pattern completes, why would you ever pass on a valid pattern for a potential pattern? Right? Does that make any sense? So trading is all about having a statistical edge, right? It's all about probabilities, right? We are playing the numbers. Understand that I have no idea which trades will win and which trades will lose. Trust me. If I did, I wouldn't take any of the losing trades and I would invest everything I have on all of the winning trades. So obviously that's not happening. So all we're doing is talking about probabilities, right? I know that if this occurs, then this is the probable outcome, right? And if we're smart with our trading, right, we're trading something where the probabilities are in our favor. That's what gives us our edge. So the only goal after that is to execute our edge as much as possible. So, right, think about it like this, like we are the casino, right? Do you guys understand that the casino has the edge in every single game? Every single game you play, the casino has the edge, right? That's how casinos make money, right? The goal of the casino isn't to predict like, oh, I'm going to take this player's money. Oh no, I'm going to take that player's money. No, it has no idea who's going to win, who's going to lose. But it knows that if people keep playing, guess what's going to be exploited? The edge, because the probabilities are on their side. So the more people they get into the casino and the longer they keep them playing, it's just going to exploit that edge more and more and more. So their goal is to keep people playing. That's why there's no windows. That's why there's fresh oxygen. That's why there's lights and bells and whistles. That's why they pump all those clocks, right? They don't want you leaving. They want you in there, free drinks, get a little loose, right? They want you in there until you lose all your money. That's the goal, right? Supermarkets are very similar as well. No clocks and windows in supermarkets. So to have something that has edge, to pass up on something that has edge, that's like passing up on a free present. But you only see it that way if you think about big picture. If you think about the end game, again, if you can't judge it off of how the last pattern performed or if this one's a winner or a loser, you just know the end game. If I consistently take this setup, then I will be profitable. So the goal is to take all of the setups that meet your rules. That's what we talk about when we say taking good trades. So in this situation, you take both, right? You take the bat pattern. If it wins or it loses, doesn't really matter. If the cipher ends up forming, guess what you do? You take the cipher as well because they're both valid setups, and our goal is to take the valid setups. So cool opportunity here on Euro Yen. Let's go to dollar Swiss next. I'm trying to avoid, did we look at like 2 pairs yesterday? Again, I went to do 14 yesterday. We ended up doing 2 because I talked the whole time. So I want to get through at least 4 today. At least I'll feel better about myself. But dollar Swiss is one that we looked at yesterday. We were looking at a rising channel into a previous level of structure, this VS1 level. Now, we watched this live. Who can tell me what happened at our VS1 level? Remember, this was the zone, this structure zone, this level of previous structure resistance. This was the zone that we were looking to hold so we can look for a counter trend move. Who can tell me what happened at that level? I didn't inform her today, Chris. I made no projections for myself. Right? We have a higher high, higher close. It's very hard to see, but if you zoom in, you'll see it. My yellow line is kind of, it's a little too thick, covering up. But we have a higher high, higher close. So what that higher high, higher close does, it invalidates the trading opportunity. Yeah, I said it. It invalidates the trading opportunity. Meaning I can't take the trade. Right? This goes back to, remember how we read a price chart, how we read structure? There's a 4-step process Jason walked you through yesterday. Identify, predict, decide, execute, right? We execute based on our decision. Our decision is based off our prediction. Our prediction is based off what we identify. So if I identify a higher high, higher close, my prediction is what? What direction do I think we're likely to go in if I identify a higher high, higher close? Bullish, right? So why would I get short? Why would I? And this is the funny thing, right? This is the funny thing. So we talked about yesterday where we get the random trader that's like, hey, long euro dollar, 110.80s. And we're like, do you actually think price is going to go there? And they're like, I don't know. And it's like, well, why the hell are you in the trade? Right? This process is this simple 4-step process. And you feel like an idiot when you learn about it. And you're like, man, why wasn't I doing this before? It is the most important thing in your trading. Because it is a process that should keep you on track. And it really brings out common sense. And it doesn't just have to be this process. It can be another process depending on, what your trading style or strategy is. But so if we just walk through the first part, identify higher high, higher close. Okay, based on me identifying that, I predict that price is likely to go higher. So right there and then, that should eliminate any thoughts of getting short, right? Would you guys agree? Yeah. So you've just filtered yourself out of a potential trade. No matter what emotions you see or have or whatever you read or about on the internet, right? We got CPI coming out in a minute and you're reading stories about how it's going to be this and you're trying to convince yourself, right? Some false confirmation bias to get short, right? You've eliminated all of that. RSI is divergent. Yeah, so what does that mean? Does RSI divergence have anything to do with the fact that we put in a higher high, higher close? Weaken it, but what does that have to do with price action? Nada, right? Now again, anyone could have their own rules, right? So I'm not if your rules state that, hey, I value RSI divergence over a violation of structure, then the RSI divergence is going to be the most important thing. So again, I'm not here to tell you that you can't value stuff. I'm just saying for me and how I trade, the thing that I value the most is structure and price action. RSI is secondary. Indicators are secondary. Fibonacci's are secondary. AB equals C, all that stuff is secondary. For me, what sets up my entire trading idea is price action, candlesticks, candlestick location, specifically where are they at in comparison to structure, right? It's the same thing like Jason talked about yesterday, right? With the moving averages, right? Who cares if he has RSI diversions if price hasn't retraced back into those moving averages, right? The first thing he's looking for is for those things to fan out and give him a directional bias. If that doesn't happen, he's not interested. So it's all about what you value. So Sarah, if you value divergence on the RSI, if that's the most important thing to you, if you value that over price action and structure and violations and stuff like that, then that's 100% fine. For me, it's just price action. So because price action has violated the level of structure, I can care less about divergence because I have zero intentions of looking to get short. Zero intentions of looking to get short. So I don't care about anything else that's pointing me to say, hey, get short. Because the one thing that is most important has not occurred. So therefore, I never get past step 1. I don't go to 2, 3, 4, or 5. That's just how I operate. Not necessarily, but maybe this is where I go wrong and you're in the money and I'm not here to tell you if you're right or wrong. That's not my job. I don't know enough about how you trade. But hopefully with the knowledge that we give you throughout this workshop, you can start answering that question for yourself. You can start answering the question of, do I have a process? Am I just looking at a single thing and basing judgment off that single thing? Maybe I should be looking at this before that. Maybe I'm doing things the right way. Again, it's not my job to judge. I don't know you well enough to really dissect your trading and understand where your flaws are. But hopefully with what we're teaching you throughout this workshop, you'll be able to do so. But I'm not right, you're not wrong. You're not right, I'm not wrong. We're only right or wrong if we're following the specific rules of our trading plan. Does that make sense, everyone? That's all that matters. Again, you can have someone that comes in with a MACD and says, hey, Keel, we got a bullish zero cross. That means we're bullish. And I could be like, I don't really care about the MACD at all. So it's irrelevant to me. Does that make that other trader wrong? No, because they're following what they want to follow. And, understand we haven't really talked about teaching, but our job, well, Jason did yesterday, right? Our job isn't to teach you, hey, trade the same way that we do. I hope that's crystal clear. We're not coming here and saying, the way I trade is the only way to trade. You trade this way or you don't trade at all. In fact, we just looked at 2 different ways to trade over the last few days, right? I taught you reading price action and ebbs and flows and 3-point moves. Jason Greystone taught you a different way to identify trend and trade with indicators. But they have something in common. What is that? What do both of those styles of trading have in common? And again, if you ask any professional trader, no professional trader will ever tell you that you're trading wrong, but they will tell you that there are key elements that every trader needs to have. And that is a process. It's a process and a rules-based trading strategy, right? A process and a rules-based trading strategy. And our job is to teach you those elements of what you need to run a successful business. And then you can take that and make it your own. You can trade like us, you can trade not like us, you can create your own thing. But understand, if you want to be successful, and this is what every trader needs to have, if you want to be successful, you will not be successful without a process and a rules-based trading strategy. I can tell you that. You will not be successful. You will not. And I have a very hard stance on that. You may get lucky for a little bit, but that's not sustainable. So, looking at higher high, higher close. So we're asking ourselves, where could price go next? So if price is likely to continue higher, guys, where do we think price is likely to continue higher to? Well, probably our next VS1 level. So you can look at this 2 ways. And this is the cool part about understanding kind of the full story of a potential move, right? So let's say we rally, get that off of here. Let's say we rally up to this next level of structure. Let's say that we're looking for a lower low, lower close for our entry, right? So if, right, this is where the rules come in. If price action comes to our next VS1 level, then I look for lower low, lower close entry, right? So let's say we have this. I'll draw a bar before it. It's going to be just roughly drawing these things on. Here's our lower low, lower close right here. What's the next thing we need to do, right? Should we take the trade? Take it, right? Should we take it? No. Well, what else do we need? Why not? Why shouldn't I take it? I got my entry reason. I if-then'd it, right? Rules based, Akil won't yell at me. Why shouldn't I take it? Don't tell me no. Tell me why. Tell me why. Ugh. Forever ingrained in my head. Gosh. Charles, you remember this cable network called The Box? No, man. So before like MTV and stuff, or maybe it was during, I don't know. There was this cable network called The Box. Yeah, Jason Gross. Yeah, and like where you would have to pay to watch music videos. So I never would pay because I'm not gonna pay to watch a music video. So you're at the mercy of whatever everyone else wants to pay for. And man, they just kept playing NSYNC over and over and over again. Yeah, I'd wait there hoping like the video I wanted to watch came on. Jason's waiting for Dr. Dre. Yeah, I would wait there. Yeah, and I'm like, is it gonna be? I'm like, oh, come on. But it's ingrained in my head forever. So anyway, we don't want to enter right away, right? Entry, stops, and targets, right? We need to see the full view of the trade, right? So let's talk about stops. Stops is going to be the easy one. For me, I use ATR stops. So stops would be 1 ATR above the highs. They need to be above this VS1 level, right? So let's say my high watermark is right here, right? 92.73. Let's say my ATR stays at 17. That's going to be 92.90s, right? Right about here is going to be my stop loss. Where would you guys, again, we're pretending we're entering right here. Where would you guys look for targets at? Right? These are the next questions. Again, Chris says 2 to 1, 1 to 1. Now, I have a big problem with that actually, but that's another topic we can save that for a different day. For me, I would only look for a retest of structure. Right? This was our previous level of structure. You can actually see a new VS1 level being printed. I would only look for a previous level of structure, right? The previous level of resistance that was broken should now act as support. So right around here. Now, there's a potential problem here. And some of you guys may be able to see it. Some of you guys may not be able to see it. What is the potential problem here? Do we have a problem here? Poor risk reward. Is this a trade I want to take? No. Now, the cool thing is that, right, if I set up my trade right away, or if I set up my trade in advance, if I plan it out, if I plan instead of just doing, I'm aware of this, right? I know that, hey, I cannot take this trade unless I get an entry right here. I can literally take my Fibonacci retracement out and see, let's say I require a minimum of 1 to 1. I can literally take my Fibonacci retracement tool out and see where a 1 to 1 risk reward ratio would need to be, right? I'll just do it for you right now, right? Instead of just talking about it, right? I'll take my fib from my stop loss, my projected stop loss. This is going to change as price moves, obviously, to my projected target level. And I can see that, hey, here, if I can grab this thing, here we go. Here's my 50%. This is where I would have a 1 to 1 risk reward ratio. So any type of entry above this level would be okay. Any type of entry below this level would give me an inverse risk reward. So I already know, right, well before this trade ever happens, or I have a good idea, I should say, of where I can enter, or where a price would have to go in order for me to enter, and where I can't enter at. And what this does is it stops me from taking bad trades, right? Because the person that just saw the lower low, lower close and took it right away and then decided to measure stops and risk and reward after the fact, guess what they're involved in? They're involved in a bad trade, right? But it gets worse. It gets worse, right? When someone's involved in a bad trade, do they usually do what they're supposed to do and exit right away? No, no, no. Why would they do that, right? They stick with it, right? And they say, you know what? I'm gonna, I'm supposed to have a 1-to-1 risk reward. I didn't have it, but I'm gonna just stretch this target out to a 1-to-1 risk reward level. And it makes them feel good because they have a 1-to-1 target level. But is their target level at a place where they actually predict price to go to? No, it's just, in a random location, right? And they're trading off a hopium. And instead of not being involved in a trade where you lose 0 for the trader that planned it out, instead of noticing that, man, I'm in a bad trade and exiting right away and, losing spread or a couple of pips, right? Damage control, they stick in it until it stops them out and they take a full loss. And that full loss takes away everything most likely from their next win. And now they've got 1 win, 1 loss, and they're break even instead of having one win, 1 loss and probably being in profit. Looks like we got a poor CPI number today. So that's how it goes. Now, let's talk about the next opportunity, right? Because this is not going to interest me too much because there's not a lot of room for profitability. But speaking of this VS1 level, the same level that if we go higher, we would expect this to hold. If we violate this level, right? Where are we, or then, if then, right? I'm supposed to do that. If we violate this level, then where are we likely to go to next? There's a few levels you can look for. Ultimately, right? Bigger picture, you can look for our VS1 level up here. Smaller picture, you can look for this minor inside VS1, right? You see this box on your left? This one that was created here, you can look for that level as well. So if we violate these highs, the next stopping point is a potential move from 92.74 all the way up to about 93.50s. And yeah, this higher level, this can be your secondary target. Now, if there were only some other tools I can use to kind of give me confirmation that this is a good level, what could I use? Is there anything else hidden here that you guys may notice? What happens if I were to take an X to A and A to B? I drew the wrong X, sorry about that. Let me get the highs up here. X to A. Swing high to swing low. It's the lowest point of this move. A to B. B to C down here. And project a CD completion. I'm going to have a potential Gartley pattern right around that level. What else did we talk about on day one? I believe we mentioned AB equals CD patterns. Swing low to swing high. Copy and paste that, drag it onto the C leg. Harmonic move, right? 1-to-1 measured move. You guys see that in yellow? All of that is complementing that level of structure that I drew out earlier. This is called building a reason for entry. Well, I guess in this case it would be exit. But this would be the same analysis you would do if you were a counter trend trader looking to get short. So if I know this is a level that I would project a reversal at, right? And again, I say level, it's not an exact price point, it's always a zone, right? Just how the VS1 level is drawn out in the box, this is a zone. If this is a zone where I would project a potential reversal at, as a buyer, this is a zone where I would want to do what at? Get out. Yeah. So I've got my target projection. So now all I need is the entry. And the entry is going to be dictated by your trading plan. I'll walk you through kind of how I would handle it. I probably should have left that. I probably should have left that up there. I don't know why I deleted it. Where is it at? Right around 93.50s, right? Yeah. So here's how I set up the trade. And we do this well in advance, right? We're nowhere near this level yet, but we do it well in advance. Why? Because like any professional, we are prepared. We are prepared, right? Something that helps with confidence, with consistency, is preparation and practice, right? The more you practice, the more confident you become. The more you prepare, the more confident you become. The more confident you become, the more you trust your plan. The more you trust your plan, the less mistakes you make. The less mistakes you make, the less money you lose. The less money you lose, the more money you keep. The more money you keep, the faster you can compound. The faster you can compound, the more money you make. And it goes on and on and on and on. Right? You see the process? Yes, it's all related. It's all related. The more confident you are, right, the more likely you are to take good trades. The more confident you are, the less likely you are to take bad trades. The less bad trades you take, the less money you lose. The less money you lose, the more money you keep. The more money you keep, the faster your account can grow. The faster your account can grow, the more money you have. And that can just go on and on and on to financial freedom and freedom of time and being able to play golf and waste a lot of money hitting balls into the trees. So yeah, simplified, make good decisions. There we go. Thank you. That was a very easy way to say it. Just make good decisions. But part of good decision making, again, is avoiding those psychological, we call it like distress. There's a difference between stress and distress, is avoiding distress. So avoiding panic. And the more you prepare, the more you notice in advance, the less panic there's going to have. So I can tell you already, I know exactly what needs to happen in order for me to take this trade, right? And this is and this may not ever happen. This may not ever happen. But if it does, I'll be ready. That's the difference between successful traders and struggling traders. Successful traders take advantage of the very little opportunities that come. Struggling traders miss it. So if price action violates this level, then I look for pullback. Make good decisions. If is MGD. If price action pulls back, this will be a good example just walking through rules. Then I look for RSI to go oversold. If RSI goes oversold, then I look for higher high, higher close. If I get higher high, higher close, then I enter long, right? I know that stops go below, 1 ATR below the previous or the current swing. Targets go at the location that we just measured out. And I can draw it on my chart. I can project it. I can predict it. I can make tweaks if price action changes. I've got a secondary entry planned. I've got a third opportunity planned, right? Sometimes a fourth, depending on how price action moves. But there's nothing about this trading opportunity that I don't know. And that's how we can approach stuff with confidence, right? You'll see myself, you'll see Jason do a lot of live trading. And we often get the question like, how are you so confident? Like price is going wild, like CPI is moving the markets and you're just sitting there and you're not panicking at all. We already know everything we need to know about the trading opportunity. And the only question that's left, right? There's nothing we can do. The only question that's left is we're just waiting for price to either do it or not do it, right? Am I wrong? Jason looks at his chart and he's just like, did we do it? Yes. Okay, I'll take it. Did we do it? No. All right, I'll wait. That's all it is. This is the waiting game. That's all it is. If you do the work beforehand, if you're prepared, if you plan. Now, I'm not going to lie. Doing it, especially as a newer trader, probably easier said than done, right? But that's where experience will come in handy, and that's where it's so important that you have that belief, and that belief is going to be, at least at the beginning, before you get experience, is going to be developed through back testing and just a true trust of your your trading system, as well as having a good community that's not going to let you do dumb stuff. That's very important as well. But we know everything about this trade before it happens, about this potential trade. The idea is there. Now it's just waiting and adjusting, waiting and adjusting, waiting and adjusting. But there's no panic. And when you have a rules-based trading plan, again, there's no like, I think we should do this. I think we should do that. We are robotic as possible, right? Sarah mentioned earlier about the trading opportunity to go short. And I can tell you this, Sarah. Let's say you made the greatest case in the world, right? Everything you said made sense. I'm like, yeah, I like the divergence. I like the engulfing candle. I like this and I like that. There's still no way I can ever take that trade. And again, it has nothing to do with you, but there's no way I can ever take that trade. And why is that? If everything was perfect, if you convinced me, and I was like, damn, that sounds good, because it's not in my plan. So I just can't do it. And we'll see that a lot. We see it all the time when we do our live trading. We're like, there's a lot of shared ideas in our live trading room, and we'll have a lot of traders typing ideas, and I'm like, man, that looks really, really good. You gonna take it to kill? I can't, man. I'm not a continuation trader. I can only look for targets that are retested structures, so the risk reward is going to work for me. But you go ahead, man. You get the glory for the both of us. Yeah. You end up doing a YouTube video to vent the frustration. But it's so true, and it's tough at first. It is tough at first because you're going to have a lot of good ideas. And a lot of those good ideas you're going to watch. You're not going to be able to get involved with your stupid rules, right? And those good ideas are going to play out. And you're going to sit there, you're going to be cursing at your computer, you're going to be cursing at us because, we taught you about rules. And if you didn't have to follow rules, you would have been in that trade. But you'll get used to it. You'll be okay. And trust me when I say that rules, again, they're going to keep you out of more dumb trades and bad trades than keep you out of the ones that work out. And here's the thing too about evolving as a trader, right? There's nothing wrong with making there's no negative in making a prediction, right? If you make a prediction and it plays out in your favor and you're not involved, that is a good thing, right? Because you are fine tuning your skills. And eventually what happens with trading is not you don't have to do this, but a lot of people add to their strategy, right? So just like me with golf, right? I started practicing with one club. I said, this 9-iron is the only thing I'm going to use throughout the entire course. I got really, really good with the 9-iron. And then as I evolved, right, I started using more and more clubs. And trading is the same way. You start with a single strategy and then you evolve, right? You make predictions, you take notes, you develop rules, you back test, and you add to what you're currently doing. You add to your arsenal. The way I'm trading right now, completely different than how I traded 10 years ago. 10 years ago, I needed the stars and the moon to align to take a trade. I needed everything. Everything needed to happen on the chart to take a trade. And I used to get very frustrated because I would make a lot of predictions and I do like YouTube videos and share charts, and those predictions would come true, and I get emails like, man, Q, you must have made a killing off of that. I'm like, yeah, must have, right? But I just started learning off of them. I started tracking my predictions. I started taking notes, started doing some quantitative analysis, keeping numbers, and eventually you add that to your repertoire, right? You add it to your strategy and you develop. You develop as a trader. And before you know it, the things that you were predicting but couldn't take 2 years ago, now all of a sudden you can take them and you've reached the next level of your trading. And that's a really cool thing. It's a really cool thing. So anyway, cool trading opportunity here on dollar Swiss. Again, it's well in advance. 2 trading opportunities. There is a counter trend one right here as well. Again, it doesn't look like that's going to have enough room for potential profitability, but you never know. You keep it on the radar. But a good opportunity here. We probably have time for, man, I used up all my time. Do we have one more maybe? We might just stop there. What do you guys have any questions really quick? I don't want to dig into another pair and then go 15 minutes over. Any questions on anything trading wise? And this would be a good time to ask it. We'll get a couple in before we gear up for our break. I'm sure I missed a few already. But I hope you guys, the point I wanted to make with this analysis is that you need to have a process, you need to have a plan. And when you have that rules-based plan, it takes the emotions out of the equation. You no longer have this, I think I should, I think I shouldn't, I feel like it will. None of that stuff matters. I shouldn't say you take away the emotions. The emotions will always be there. You'll always think, you always have a gut feeling. You just won't act on them. And that's the main thing. We will never get rid of emotions as traders or as human beings. The divide that needs to happen is, are you going to act on your emotions or are you not going to act on your emotions? That's going to be the main thing. And when you are process-based, and when you are rules-based, it just limits the chances of you taking action based off of your emotions.